Shidim Shari morning instead of the weekly uh, weekend review that I do every Saturday. I've decided that maybe for this weekend I do a special session on recession preparation. I believe I did something similar to this last December. It's been a while, and I'm too lazy to go back and look at the list of videos that I did. That I went through a bunch of sectors ETF to show how they perform against the S&P 500 during a recession, during the last recession. So today I'm gonna do something similar, but hopefully expanding the sectors to look at so that we can observe a wide scope of what we can do. Okay. First up, let's take a look at the VIX of what it did. The last two trading days, the last week has been elevated, right? So we have action that showed that caution, selling was going on, and then the last two sessions. Now, surely, if you look at this 12 months chart, you would say, "Oh my God!" In the previous two times it pierced through frenzy, it was a buy. Last October, no doubt, right? If you bought it during October, you were greatly rewarded by December. Same thing here in April. If you bought the crash in April, well, the correction in April, whatever you want to call it, you were rewarded very quickly as well. Not even a month later, you were in the green if you bought the right stuff. So for the past couple of days, I talk about the 20, and I don't think anyone would have guessed that we did almost 30. Now, does that mean that it's time to plow in all the cash you have on your sideline into the market? Absolutely not, because as always, you gotta peer back into history. This is a 3-year chart. Okay, for 3 years, we have been in this downtrend of risk, volatility. We spoiled. The pandemic completely changed the mindset of investors, consumers, you name it. History will look back at 2020 through 2024 as 4 years of chaos. It changed consumers, it changed social structure, work habits, you name it. A lot of bad things happened, but we broke out. We can go into back into normality. Okay, so take a look. So that's a 3-year chart. Let's go back as far as 20 years. Yeah, this is the normal. The old normal used to be 35, not 20. All right, so keep in mind that if we are returning to that elevated level of volatility, 30 is nothing. It's okay, normal. Okay, it is as normal as 15 used to be as far as 30. Right, so keep your head on the swivel. Just look at 2008, 2009, the last recession. Okay, it pierced through 35 multiple times until all hell break loose. Okay, so even before the pandemic, look, see, so try to understand the one other thing about younger, like as I get older, no doubt I know that there's a lot of younger traders, people in their 20s and 30s and even 40s entering into the market. And a lot of people are just not well seasoned into looking back at the past. I am well seasoned into looking at the past. Does not mean that I'm the best trader. It's just that I have seen enough, been through enough battles to know that what we got yesterday, the day before, is bad. I'm not gonna sugarcoat it. It is bad, but it's far from the worst. Okay, it's far from it. So, um, if you're new to the market, get ready. This is not the end of the worst. There's no such thing. Okay, so let's pivot into some um, key tickers and indices before I go into historical comparison. Um, but before that, let's go into Bitcoin first. Okay, Bitcoin. Let's go back to the 1 year chart. I bought yesterday. Even after hour, I bought because it went down lower during after hour. But no, it came down to what I think is a key support trend. Okay, because look, bang, bang, pierced through it. Took a week, got back in there, right? So now it is back. Zoom in, right? So yeah, I I don't mind adding yesterday and even after hour last night. We'll see how it goes. Okay, now should you have a stop? You can. If you want to have a stop, put a stop in at the gap up, and then put a buy order in on the gap fill. Okay, that's just the way you can play. I don't know about you, but let's see, the gap up low is 68.45, and the gap fill would be 58.790. Okay, so that's enough, right? 2.5% ish to save. So normally on situation like this, if, okay, I'm using the word if because I don't have it right now. If I'm gonna put in a gap fill, I won't do on the whole position. I would do like maybe on 1/3 or 1/2, and then put in a bigger buy order at the gap fill so that I increase my position. That's how I would do it. It's not the same in every situation, but that's how I would plan for BTC. Okay, let's take a look at TLT. Nice move. Finish up over 98. And as impressive as the move has been this past week, it is not even back to where it was at the start of the year. This is where we were at the start of the year, over 100. Okay, so let's not get twisted that uh, the move is over. As I mentioned in the chat group uh, yesterday, during the day, that if you don't have enough exposure to TLT, buying here is not a bad idea. If you have beyond 3 months horizon, because, well, unless you are not in the camp of we're not going into a recession. If you are in that camp for whatever reason, if you're in the camp that, oh, this is just a soft landing, there is no way, there are still people out there calling for a higher rate because inflation is raging still. It's gonna come back in a vengeance. Oh no, whatever. Okay, whatever. Those people just think that I don't know. I don't even know. I can't even understand the mindset of those kind of people. But there's always different views in the market. So if you are in the camp that believe that we are heading into a recession, then buying TLT here is a good idea. Okay, a good idea. In fact, will there be a pullback? Absolutely. I don't know when, I don't know where, but you see this 1, 2, 3, 4 days in a row of up. Do I think that it's gonna keep on going up, 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 up? No, 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 no. Okay, no, absolutely not. Um, there will be pullbacks, and if you want to add more to your position, you can. I'm not telling people to buy yesterday. I didn't say that. I just said that if you want to add to TOT, there's still time to add. That's a key word. Okay, there's still time to add. On pullbacks, not a bad idea to do so. Why? Why did I say that? Here's a 3-year chart. All right, so right now the Fed fund rate is 5.25%. If you go back and look at when the Fed start to raise rate, surely I am in the camp. I'm not sure if other people have talked about this. I talk about this. I voice this to the members of the group that I believe we are going to get a 50 bips cut in September, October, November, December, January. 4 big cut in a row of 0.5. That's my prediction. I'm pretty sure nobody else out there make that prediction. That's my call. And then we're going to go into quarter point cut in February and a quarter point cut in March. So between September and March, we're going to drop 3%. So if the Fed fund rate dropped from 5.25 down to 3.25, then the 20-year, 30-year Treasury yield, because that's what TLT is. Okay, TLT is 20 plus. So the portfolio, the holdings of TLT ETF is a mix of 20 to 30 years duration treasuries. That's why I use both 20 and 30 years yield. If that's the case, then I can see TLT rising anywhere from 20 to 30%, at least 20% from where we are right now. If yield drop from if the Fed fund rate drop from 5.25 to 3.25, and then you're looking at up here, the 113 to 115. Can we get to 118? Possibly. Remember, the market, even the bond market, is a forward mechanism. So if the Fed cut rate down to 3.25 and the economy is still terrible or still getting worse, usually it's getting worse. For those that watched the video yesterday, when I discussed that, well, the one that I discussed about the 1992 recession, that for a year and a half plus, unemployment rate increase from the time the Fed cut rate. So these things it take a long time to heal a recession. So, but do I see 118 and above in 9 months? Yeah. Uh, hey, if it's 118 and above, you're talking a 20% return. Okay, and it's possible. I do see it in the next 9 months. Now, is 20% return a big deal in the next 9 months? Well, it's nice. I don't think anybody that had been in the market for a long time would say, "Oh, that's all? 20% in the next 9 months?" Well, in a recession, good luck trying to find a lot of stock that's going to go up 20% in the next 9 months. Okay, so there's a lot of traders, investors that have not been through a recession. That's the thing. YouTube is filled with young influencers that has not been through a recession. So, they would never tell you to invest in TLT. They still want you to buy up Palantir. Okay? Dia, the Dow Jones. Okay. Not pretty. Not pretty. Occasionally, you will hear the term TA-wise. Okay? TA-wise is technical analysis wise. I use that term because I don't have a better way to express what I want to say. But whenever you hear the term TA-wise, that means that a stock is trading very technically. By that I mean that it's moving fast toward a level. From level to level, it moves fast. Because basically when something trade TA-wise, the bots are in more control of the destinations because there's less people in the middle. Between any two levels, between, for example, DIA, between the 20 and the 50, those that ignore TA are the one buying and selling more than the bots. In general, I'm not saying the bots are not in there. For example, if a bot is trading on the short side, can a bot be trading, selling all the way until it hit this thing to cover? Yeah. I'm not saying the bot are not involved at all. But who are the one buying if the bots are selling into the next level of support, right? So just understand that the more the bot is in control, the faster the movement is going from level to level. Okay, so the market trade very TA wise the last 2 days. If you go to any ticker, you see that it came down to support real fast. Okay, so DIA, now, would I buy DIA here? Absolutely not. Okay, absolutely not. Would I buy DIA if I see 200? Yeah. Okay, there's no need to rush into DIA right now. It has wiped out all the gains since March. Okay, so no thanks. SPY. Once again, you see that? Very TA wise. Came right down, sliced right through the 50, came right to the 100 and bounced. Okay, that's very TA wise. Okay, so yeah, same thing here. Since May, basically all the gains since the end of April. See, April's right here. Well, end of May, I mean. May. Okay, May. This is beginning mid-May, end of May. Gone. Very fast. Okay, very fast. Take the stairs up, elevator down. 2 months of gain, wipe out in a month. Always. Now, would I buy SPY? No. Okay, no. Would I buy it just like DIA? If you want to just buy the market, 200. Whenever, wherever it is. Next week, next month, if you see it, listen, the market have had a great bull run. The last time it was at the 200 was way back in last October. It has been an insane 10 months bull run. So it will revisit the 200 between now and October. You will see it. Okay, so have some patience. QQQ, nasty. Nasty, okay? You notice I took out a lot of the fib chart because once when the SPY was breaking into all-time high, I used fib extension and I took that off because now it go into fib. Okay, let's go back to SPY. I forgot to, yeah, let's do a fib retracement. The question is where. Okay, so you can do You can do it from here. Last time it touched. Let's do a fib retracement. 565.16. There we go. Look at that. Line up right where the 100 is. Now, if you want to buy the 61.8, that's potentially the next area, right? Many people love 61.8 fib. So as far as going long, if you want to do something there, 520-ish, 519, yeah, be my guest. If not, look, the 78.6 fib kind of line up with this level of support, very minor. Okay, this is very minor here, but use the fib. QQQ. It has retraced. Well, once again, let's take out this retracement extension. Actually, no. This was the extension that I ran when it break record, right? So we did the extension, and guess what? It got to a fib level as far as the top. So it works, okay? It works as far as fibs. Let's remove this. Now let's do a fib retracement. So let's use this low right here as the start. Let's go fib retracement 503. There we go. So that's the way I use a fib. Okay, so whenever something break into all-time high, I use fib extension to figure out where potentially the next price discovery rare air place to sell, to trim. And then once it retraced like this, then we switch back to fib retracement to see where the next support level is. And look at that. Look at that. 61.8. See that? Yeah. Like I said, level to level. TA wise. Okay? It's I can't stress enough how it is very important for traders to understand how to use TA. All TA, trend line, channel, MA, moving average, fib, use them all. The tools are there. You can't be day trading, swing trading, and listen to other YouTubers. Please don't, okay? My goal and job here on YouTube is not to tell you what to buy. I'm hoping to illustrate how to use the tools to trade on your own on the stock that you like. Certainly not everybody watching this video are trading the exact same stocks. I doubt it. If you are, I don't, fine, I don't care. But there's only so much ears and eyes that I can pay attention to as far as the stock market. It's hard to follow everything. I can't. I don't have enough brain capacity and eyes to follow 6,000 stocks. But if there's a stock that you like, if somebody in your friends family group say, hey man, you should buy XYZ, then throw that stock into the chart to see if there is a good spot to buy or sell. It's that simple. Okay, use a tool. So once again, TA wise, look, this is a very good TA chart as far as because it lined up very. Look at where the 200 is. It's lined up nicely with the 78.6 fib. So yeah, 429, giddy up. Okay, giddy up. I will be outright buying the QQQ, which I have not done in a long time. Okay, it's easy to not pick which one of the Max 7 to buy. I might still buy some Max 7 depending on what the TA is individually, but QQQ, wherever the the 200 is a buy. Okay. Last for this indices before we go into sector, IWM. Yeah, what can I say? Yeah, yeah. I have enough exposure with small cap in the biotech sectors. I said this a few times already. This is why I don't trade the IWM and likely will never trade the IWM because I have enough exposure in small biotech. But yeah, I don't know what to tell you. Tom Lee was right for 3 weeks. He'd been wrong since Christmas, and then he was right for 3 weeks, and then welcome home, Tom Lee. Okay, I'm not picking on Tom Lee. I'm picking on Tom Lee at time because, like many people on CNBC, many, if not all of them, all of these people come on CNBC on a weekly basis. Tom Lee is on CNBC twice a week, if not more, making all kind of calls. And like Nostradamus, if you throw out 100 prediction, you might get 25 right. But CNBC is an entertainment slash propaganda show channel. Okay, their job is not to call out people that make mistake, to embarrass them, and then have no guests. Because guess what? If CNBC is about facts and held everyone accountable for every stupid call they make, all the guests will disappear. They will run away in shame. That's why you rarely hear CNBC hosts say, "Hey, Tom, last year when you make a call that Bitcoin is going to be 500,000, what happened?" Of course, they will never ask that kind of question. Okay, so Tom Lee make all kind of crazy calls, and he get all the praise from all the hosts from the few things he got right, but they cannot ignore the others 75% he got wrong. Nonsense. He's a clown. Stop listening to clown. Yikes. It's cringe. Every time he's on TV, I cringe. Because I know a lot of people love Tom Lee. He's so great. Yeah. All right. Before I go on to the sector, let's take one look at a sector that should do well. GLD. Okay. We are near the top. Does that mean that it's top out? No. Gold and gold related stock will do well in a recession. So if you are in the camp that there is a recession, buy gold on a pullback. Yesterday I had ordered in. It didn't trigger. 222, 218. My order stayed there to add more to my gold position. Okay, so if it break into new high, then I will flip the fib into fib extension to see how far it can go. Okay, so that's it. I like gold. There are levels to buy down here, and for whatever silly reason, gold is down to 215, 216, where the 100 MA is. Buy in size. I will. I got a lot, but I wouldn't mind owning even a lot more gold. Okay. All right. Let's go into sector analysis of the past recession. Okay. We're going to the meat of. Okay, I'm using SPX. Let's go back in time to time frame. custom 2008 to the end of 2009. 2 years. There you go. That's what the S&P 500 looked like. Yeah, the bottom, March. Wow, right? Wow. For those that have been on my channel in a while, you know how I said that to stay away from energy, right? I have small exposure in energy, not big. A few share of Schlumberger. I sold out of Halliburton. I have a few share, a small position in Chesapeake and CTRA. So that's it. That's everything. Okay. I have a couple of put that expire, worthless USO at 73, 72 yesterday. Fine. I did not reload them yet. But if I was to reload those put spread, it's gonna be 70 and lower because energy, oil will drop like a rock. But let's take a look what's going on with the sector. Look, there you go. You see this? That's XLE, the energy ETF. If the S&P 500 dropped, guess what? Energy dropped even worse and rebound even slower. Okay? Slower. So, I'm not giddy up on anything energy. Okay? I will look to trim out of my energy bet on pop. Keep in mind, between now and September, there will be chances for me to get out of many positions that are in sectors that are unfavorable to own. I didn't run out the door yesterday. I fully understand that there will be ups and downs, both for TLT and the rest of the equity market. So chill, panic, fear is not a strategy to trade. Okay, there will be ups and downs. There will be chances to get out. No need to rush out the door like a fool. So it's clear, right? That energy is not the place to be. Okay, next, let's keep on adding. Okay, next, let's add financial, which is XLF. Now, if you want to understand the individual sector, Google is your friend. Okay, so XLE is the energy sector that I just showed. Now it is XLF. So if you're curious to see what's the holding of each, go and Google, like, it would give you the detail of what is in each ETF, what is the percentage weight of the stock in the ETF. So you see it for yourself. I can spoon feed everything, okay? XLF, finance. Oh boy, it's even worse. Now, remember, the last recession, financial crisis, was housing related. I'm not saying that it can't be the same this time, but every recession is slightly different. Okay, every recession is slightly different. So I'm not gonna say that financial is gonna have the same magnitude kind of decline. There is no way to know. Not right now, not yet. We will find out eventually what sector is going to get hit the worst. Okay, so from looking at this chart, as you can see, the energy, the purple, did a lot better than the financial, but you can understand why. The financial went through a nasty crash with all the banks bankruptcy of Lehman Brothers, Bear Stearns, and near bankruptcy of many other one. You know, all the firm that Wells Fargo, Bank of America had to buy up to save them, like Countrywide. Remember Countrywide? For those that have been in the market long enough, the mortgage giant had to be swallowed up. Merrill Lynch had to be swallowed up by Bank of America, or they would have go belly up too. So yeah, it's ugly. So I don't think financial is gonna be as ugly this time, but it's too early to call. Yet it's also a sector to not be so bullish on. Okay, let's add a few more before we remove them because it gets busy. The chart gets super busy the more you add things to it. Okay, so what's next? What's next? Utility. Okay, utility. Let's add utility, which is XLU. XLU. Ah, look at that. Utility. This is why you hear some people on YouTube recommending utility. But is this something you want to buy? Sure, it did better than the S&P 500, but it's still pretty bad. Okay. Sure, it declined, but look at this point. At the worst, it's still down like 40+%, 45%. So yeah, the S&P went down 49. So is this something to hang your hat that you're down only 45? No, I don't want that either. Okay, so no thank you. Let's do one more before we clean up the chart. Industrial, okay, the Honeywell, the GE, the Boeing, XLI. There you go. Once again, do you want this? Who want this? No, I don't want this. Okay, I don't. Do you want this? No, I don't. The GE, the Boeing, the Honeywell, the Illinois Tool Works, Black and Decker. No, no, no thanks. Okay, no thanks. Not a chance. Okay, so let's remove some of these. Remove study. Yes. Remove study. Remove study. Yes. All right. I'm gonna leave the last one I just add, industrial, just to show you that there is not. Okay, so next one up. Let's go with GDX, the gold miner. Okay. Let's see. Let's see. Let's see how they do. Are they as good as I say? Probably not, but we'll find out. Wow, look at that. I like that. Okay, I like that. I'm willing to buy something that perform worse, but look at that ripped. Yeah, there's a reason why I said go for the GDX. Okay, it's higher risk, higher reward, but I'm willing to take this chart, this sector over everything else that I have shown so far. So far I show you 5 sector ETF, and no doubt GDX is the best of the bunch. And I don't think GDX is gonna suffer this kind of decline like the last one. That's just me. I can go into greater detail if you want on why I think that way. But every recession is a little bit different, and I think this time is very different, very, very, very different. Okay, and I like GDX. Next one, let's take a look at technology. I'm sure a lot of people have a lot of exposure here, and let's take a look. Let's see how technology do. XLK. Okay, into the decline. It's pretty bad. Okay, at the worst, it was 1% or so less bad than the SPY because technology is a big part of SPY, right? Technology company are a big part of the S&P 500, so it's not a surprise that it did that. But technology also bounced back better than other sectors of the S&P 500. So you can see, okay, so if you see a big wash in technology, there's a reason why they will bounce back harder. Okay, so it's not a bad ETF if you can time the right bottom to buy. Okay, or or you can buy the XL this ETF, which is the XLK. You can buy the XLK and be able to handle the pain, just knowing that when the market rebound, it will do much better than the SPY. Okay, there is sector to me. This is why I'm not a fan of just like buy the SPY and be fine. We are living in a technologically innovative world. Technology always advance. Technology always mutate, change. That's where growth are. So if you're gonna buy an ETF, there's so many more better ETF to own than SPY. Okay, SPY, S&P 500, XLK. Okay, even through the recession, it will suffer this equal pain, but it will rebound much, much better. All right. All right, let's add one more before we move to a different sector. Next one is going to go healthcare. Healthcare, let's go. Healthcare. One of my favorite sector, by the way, into a recession. Healthcare is XLV. There you go, XLV. Now, take a look at this. Healthcare. It declined much less. So, this is one ETF to hold or to buy into if you want exposure to equity and willing to take some pain, but also understand that you're likely to be ahead of the SPY through this mess. Okay? Yes, at the worst, it still declined 30% or more. But yeah, it's way, way ahead of the SPX, okay? Way ahead. So there you go. I put that right next to GDX, even better because it's definitely less volatile than GDX and held up really well through the recession, really well. Now, before we move on to the next bunch of comparison, why is healthcare behave this way? First, the component of this is, of course, the health insurers, okay, like the Elements, the Humana, the Cigna, the United Healthcare. In a recession, those companies lay off. Let's say we have unemployment going from 5% of right now. We're going from 4.3% to say 6%. Sure, they lose 1.5, 2% of membership because the company lay people off and then they're no longer part of the plan after a month or two, and they're not going to go with Cobra. But at the same time, the people that have jobs are still, so they might lose 2 or 3% of membership, But anyone that know health insurance company, guess what? I have been buying private health insurance with Blue Cross and Blue Shield for 25 years. And I can tell you, they did not cut premium. Blue Cross and Blue Shield did not cut premium in 2008, 2009, or 2010. They raised them, right? So these vampire of a sector are filled with greed, right? This is one, the healthcare system is broken, but I don't have an answer on how to fix it. All I know is this company will make money. They're not gonna have terrible numbers in a recession. They might have flat number in a recession, but they're not gonna have terrible number compared to other sector where the consumer will pull back even harder. Okay, so I like this sector a lot. So yeah, that's why I have been trying to buy more Humana and Cigna on this pullback, and I will keep adding to them on this pullback. Okay, that's it's easy to do. All right, let's remove a bunch of these because the chart gets super busy if I don't, and then we can't see anything. Okay, I'm leaving the healthcare there so that we can see if there's a good benchmark to use. Okay, next up, we're gonna go with consumer discretionary. Consumer discretionary. Okay, this one sector ETF I kind of don't like because it includes things that should do well or better in a recession. For example, it has discretionary. We know the term. It's not essential, right? So it's a sector that um, can be like even traveling, right? Hotel, airline ticket. So those sector also belong to other ETF, but it's Disney, it's Netflix. Um, to me, and then of course McDonald's, and then it include fancier restaurant, like Cheesecake Factory, and then they go into the higher end brand foodie stuff, and I'm just like, no, it's not the same. The Chipotle, the Wendy's, the McDonald's are way cheap. Those tend to do very stable in a recession. So it's kind of not fair to put them in the category of discretionary because they tend to do much better than other discretionary like clothing, fashion, makeup. Okay, so fancy bags like Coach brand. It's like I said, there's a lot of things that I have disagreement with as far as what's called discretionary. And I think if there's one sector that I have the most disagreement with is this sector. All right, so just throw it out there so that even if this sector look terrible on the chart, I think they're all component of this sector. Oh, look at that. Look at that. Okay. Yeah, it suffered poorly into a recession, into the bottom, but look at that. It ripped strong. Okay, so consumer will cut back hard, but they will also come back hard. We are a consumption economy, right? We are addicted to consume things we don't need. So yeah, it come back even stronger than healthcare. So yeah, pick and choose your discretionary, right? So I'm not saying to avoid. Definitely, you don't want to buy into the discretionary area here. Like the booking, Airbnb. I wouldn't be touching it. But you know how after the pandemic, the lockdown was over, there was revenge traveling. Such a stupid term, revenge. Whatever. And that's how booking and Airbnb exploded. So there will be bad numbers for the bookings, the Airbnb of the world, the Disney of the world. But there will be revenge spending. So stupid. Uh, not that I have a better word to use or term to use, but revenge. Yeah, whatever. All right, next up, let's do consumer staples. Okay, consumer staples, the necessity. Okay, this is the kind of stuff that should do well or more stable, pun intended. XLP. XLP. There you go. Essential. That's why they call consumer staple. Okay, this is solid as it can be, if not the most solid sector. It went down less and it bounced back pretty good too, right? So if you're gonna buy a sector ETF right now and hold through this mess, consumer staples, okay, is a place to be. Just buy XLP. So you can skip looking at individual stock if you wish. To me, XLP is the place to be. You can Google XLP to see the individual component, and you see very, very common name in there. Okay, but this is why it's consumer staple. It's a necessity. It's the kind of thing that even people that got laid off still consume. They would consume less discretionary, right? They would travel less, they will eat out less, but the necessity, the toilet paper, the cereal, the necessity, okay, the cheese, food, grocery store, right? So let's do one more before we change the chart again. Materials, okay, XLB. XLB. Let's do XLB before we change the chart again. XLB. Where are you? Are you here? Yeah, that's it. No, it's a definite no, right? XLB. No, I can't say enough that it basically did worse than the S&P 500, and then worse is relative. Okay, within 2 or 3%, and then it's also kind of matched. You don't need that. Okay, if you want to have exposure to materials, you can have the same exposure holding the S&P 500 because that's part of the S&P 500. So it's definite. It's definitely not a sector ETF that I would say, oh, let's buy the material sector. Might as well buy the S&P 500. There's nothing special about this, okay? Nothing special about this ETF whatsoever. It's the meh. Okay, so let's do one more before we clean up the chart again. Let's do oil. Ooh, this is gonna be a good one. XOP. XOP is oil and gas exploration. Okay, look at that craziness, craziness. But this is why I mentioned before I don't like to invest in oil or energy. Okay, don't like it at all. You see this big spike before the recession. It kind of remind you of oil in the mid 80s or low 80s that we have 2 weeks ago. Nonsense. Nonsense. What is the reason? Can anyone tell me why USO was over 80 for a couple weeks? What is the reason? It's so foolish as far as the narrative, like why you should be, why people are bullish on oil. On what? On what? Nonsense. Okay, so no, no thanks on energy. No thanks. All right, let's remove everything. Remove. I'm gonna leave the best one on. Okay, so that we all have like a gauge of what's a good one to own. And of course, the good one is the staple, right? So I'm leaving the staple. I'm removing the healthcare. Removing the material. All right, let's do another slate before I'm calling it done. Okay. Real estate. Can anyone guess how this is gonna do? I would stay clear of this nonsense, but we'll take a look. IYR. IYR. Now I can understand why I did so poorly last recession, okay? Because that was heavily housing mortgage related. Is it going to be the same this time? It could be, but I don't need to be there. The bottom line is I don't want to be there or need to be there. Heck no. Heck no. Heck no. Okay. Now the other one is XHB. I will throw in that one real quick too. XHB is the ETF for home builder as well, and that one include the Home Depot, the Whirlpool. So let's take a look. It did better, and I think a lot of that had to do with the Home Depot. Okay, people still buy and renovate. In fact, it did. It it came down just as hard as the S&P 500, right? But then it bounced back a little bit better. Doesn't mean I want to be in it. So it did better than the U.S. real estate ETF, but still, it's not a sector that I care to be in. Okay, definitely not. Let's go to energy. We did that already. Retail. XRT. Oof. Like I said, I'm not surprised on this at all. Look, we are a consumption economy, right? We consume, we shop. Our GDP is heavily weighted into people shopping. Okay, so this is not a shock. Okay, so if you can weather the storm, unless there is a zombie apocalypse and people change their spending habit, because we can't. Okay, we can't. Revenge spending. Revenge spending is coming. Okay, so not a bad sector, right? Look at that. Yeah, revenge spending is strong. So I would not discourage anyone for avoiding the XRT. Okay, if you can weather the pain, on the way down, hard to pick the bottom, but keep your eyes out on XRT. Revenge spending is on the way. Okay, let's do two more, and then I will consider done. Okay, let's do drug. IBB. Look at that thing. Goodness gracious, that looked pretty good, right? Look at that. Yeah, this is why. This is why I am big on pharma. Okay, pharma move on drug innovation, essential. Even in bad time, people that are sick that need the medicine, they still buy the medicine. Okay, this is the best of the bunch. Does anyone dispute so far? Okay, IBB. Now let's throw in XBI, the biotech ETF, and see. But IBB, okay, I have plenty of exposure with Merck, Pfizer, so I don't need to buy, but I wouldn't mind owning IBB if I don't have exposure in Merck or AbbVie or Eli Lilly, things like that, okay? But XBI is, of course, the biotech. Similar, okay? Similar. Not bad at all, right? Not bad at all. That's why I like those two sectors. That's why you see me owning, talk about them, buying them. I'm not scared. I'm not scared of pharma or biotech. Okay, not scared at all. Not scared at all. Let's do one more. Telecom. This is long enough right now, right? XTL. Telecom. Where are you? I don't see you. Maybe it doesn't exist yet. That's why. For some reason, it doesn't show up. So let's remove this. Let's try it one more time. Why is that doesn't work? XTL. XTL. Maybe it doesn't exist back then, back in the last Great Recession. Well, the only thing left that I can tell you is let's one more. Let's do banks. KBE. Okay, this is banks, not the financial one. Include brokers, you know, like the Morgan Stanley, the Goldman Sachs. But this is banks. Okay, this is pure bank. You can also do KRE or regional bank, but this is big bank like the Wells Fargo, the JP Morgan of the world. Okay, and I suspect this is going to be bad because, of course, the financial crisis last time involving mortgage, all that stuff. So I don't expect anything good. Now, I don't expect the similar thing. We don't know. Okay, but yeah, I'm not surprised how bad this sector look. We don't know where the main damage is going to be for this coming recession yet. So I can't say that it's going to be similar, but it's still not a sector I like because at the end of the day, the problem with banks is what? Who hold the debt? Who hold the debt on car loan, home loan, credit card loan? So what recession does not go hand in hand with people not paying those things? So is this going to be different this time? I can't imagine. So I don't expect the same magnitude. It could be worse. It could be much worse because the bubble that we created the last 4 years with free money and printing money, it could be much worse. We are all-time high in credit card debt, home debt, student loan debt, you name it. The debt is beyond imagination. So I don't know. It could be worse. So banks, no thank you. So if you love the JPM, the Wells Fargo, make sure you get the F out. Because hell is coming for them. Okay, it could be different level of hell, but hell is coming. All right, I think this stream hopefully is as helpful as it can be as far as what sector to avoid, what sector to invest in. As you can see, there's not a whole lot of good sectors to buy, right? Compared to the bad stuff, there are 3 or 4 that are decent, from IPB, the XBI, the consumer discretionary, if you have the stomach to handle the pain. But there's a lot of sector to avoid. But there are a handful of good stuff to buy, and that's the kind of stuff that I already hold. Okay, so I position my portfolio as such to weather the storm, and everybody should, if you have the time to put in to reallocate your portfolio. Okay, and that's it for this. Thank you for watching. Bye bye.